Most investors think the BRRRR strategy is dead in 2026. Rising rates, tighter lending criteria, sky-high refurbishment costs. The headlines make it sound impossible. But here is the truth. We just closed a BRRRR deal in the northwest of England that returned every single penny of capital invested within 6 months, generating a gross yield of over 8% and leaving zero of our own money in the deal. In the next 15 minutes, I am going to walk you through that deal number by number, every cost, every decision, every mistake, so you can replicate it on your next project. Stay with me, because the refinancing stage alone will change how you think about property investing forever. Welcome back to Property Investor TV, the channel where we cut through the noise and give you real numbers, real deals, and a real framework for building a property portfolio that lasts. If you are new here, we cover buy-to-let strategy, portfolio financing, and market analysis across the UK, Europe, and the United States. Hit subscribe now so you never miss a weekly release. In this video, you are going to learn exactly how the BRRRR cycle works in today's rate environment, what lenders are actually offering on buy-to-let refinance products right now, and how to stress test a deal before you commit a single pound. We will walk through a live North West case study with full numbers at every stage. And stay until the end, because in the conclusion I am going to reveal the single most common mistake investors make at the refinancing stage, a mistake that quietly kills the entire strategy and leaves capital permanently trapped in the deal. What the BRRRR strategy actually is, and why it still works. B-roll note, aerial footage of terraced residential streets in a northern English town, transitioning to interior shots of a property mid-refurbishment. Let us start at the foundation, because even experienced investors sometimes misunderstand what makes the BRRRR model genuinely powerful. BRRRR stands for buy, refurbish, rent, refinance, repeat. On the surface it sounds straightforward, but the real genius of the strategy lies in capital recycling, the ability to pull your original investment back out of a deal through a refinance and then deploy that same capital into the next acquisition. Here is why it still works in 2026 despite the rate environment. The strategy does not rely on a low base rate to be profitable. It relies on three things: buying below market value, adding genuine value through refurbishment, and securing a post-works valuation high enough to support a refinance that returns your initial capital. Rates affect your cash flow margins, yes, but if your purchase price, refurbishment budget, and rental income are all correctly structured, the model remains entirely viable. Consider the broader context. UK house prices in the most investable northern markets, Greater Manchester, West Yorkshire, the Midlands, have held remarkably firm through the rate correction of the past 2 years. Rental demand, meanwhile, has continued to outpace supply. According to Rightmove's rental tracker, average asking rents across Great Britain rose by 7% year-on-year in 2025, with some northern cities recording double that figure. Supply of available rental properties remains near historic lows. That is precisely the environment where a well-executed BRRRR deal delivers outsized returns relative to risk. The key shift in 2026 is that the strategy now demands greater precision than it did in the low-rate era of 2019 or 2020. You cannot rely on a rising market to paper over a weak purchase price or an overspent refurbishment. The numbers must work from day one. And that is exactly what we are going to show you now. The live deal, numbers, costs, and the purchase stage. B-roll note, close-up shots of a deal analysis spreadsheet on a laptop screen. Hand typing, transitioning to exterior shots of a Victorian terraced property with a for sale board outside. Our case study property is a 3-bedroom Victorian terrace in Salford, Greater Manchester. It was listed by a local estate agent at £115,000. It had been sitting on the market for 11 weeks, had a failed sale behind it, and the vendor, an elderly landlord exiting the sector, needed a clean, fast transaction. That is precisely the kind of motivated seller profile you are looking for in a BRRRR acquisition. We made an offer of £94,000. After 2 rounds of negotiation, we agreed at £98,000. That is a 14.8% discount to asking price, and, critically, a significant discount to what we projected the post-refurbishment value would be. Now let us account for all acquisition costs, because this is where many newer investors make their first error. They calculate profit on purchase price alone and forget the full cost of entry. Stamp duty on this purchase came to £2,900 under the current buy-to-let surcharge rules. Legal fees were £1,400. Survey and valuation fees totaled £650. Bridging finance arrangement fee was £980. Total acquisition costs on top of the purchase price, £5,930. So our true entry cost into this asset before a single nail was driven was £103,930. We funded the purchase using a short-term bridging loan at 0.85% per month from a specialist lender, secured against the property. The loan covered 70% of the purchase price, meaning we put in £29,400 of our own capital at completion, plus the £5,930 in fees. Total cash deployed at purchase, £35,330. One point I want to emphasize here: bridging finance is not cheap, and it should not be treated as a long-term funding solution. It is a tool, a precision instrument, designed to get you into a deal quickly and hold you there while you manufacture value. Your entire refurbishment timeline must be engineered around minimizing the number of months that bridging interest is accruing. Every week of delay costs money. On this deal, every additional month at 0.85% on a £68,600 loan cost us £583. That is not catastrophic, but it is a figure that demands respect. The refurbishment stage, budget, management, and maximizing valuation. B-roll note: time lapse or sequential before and after footage of a property refurbishment. Kitchen strip out, replastering, new flooring, bathroom installation, and final dressed interior. The refurbishment budget on this project was set at £22,000. I want to be precise about where every pound of that went, because this is the stage that either makes or destroys a BRRRR deal. Kitchen supply and installation came to £4,800. Bathroom replacement was £2,600. Full rewire to bring the property up to current EICR standards cost £3,200. Replastering throughout the ground floor and first floor landing, £2,400. New flooring across the entire property, LVT downstairs, carpet upstairs, was £2,100. External works including pointing, guttering, and a new front door came to £1,400. Decoration throughout, £1,800. Contingency used, £1,200. Miscellaneous materials and skips, £2,500. Total actual spend, £22,000. We hit the budget almost exactly, which is not an accident. It is the result of having fixed price quotes from every single contractor before works commenced. Now, the most important figure in this entire analysis is not what you spend on the refurbishment. It is the gross development value, the post-works valuation, because that is the number that drives your refinance. We commissioned a Rick's Red Book valuation once works were complete. The surveyor valued the property at £148,000. Let us pause on that for a moment. We purchased at £98,000, spent £22,000 on refurbishment, and the property is now worth £148,000. That is £28,000 of equity manufactured above our total investment in the asset. That uplift is the engine of the entire strategy, and it did not come from a rising market. It came from deliberate, targeted improvements that align with what comparable properties in that postcode are achieving on the open market. Refinancing, rental income, and calculating your money left in B-roll note, screen recording of a mortgage comparison tool or lender product table, transitioning to footage of a letting agent showing a clean, refurbished property to prospective tenants. With the post-works valuation confirmed at £148,000, we moved immediately to refinance onto a standard buy-to-let mortgage. In 2026, the buy-to-let mortgage market has stabilized somewhat following the volatility of 2023 and 2024. 5-year fixed rates from mainstream portfolio lenders are currently sitting in the range of 4.4% to 5.1% for 75% loan-to-value products. We secured a rate of 4.65% fixed for 5 years with a specialist buy-to-let lender operating in the portfolio landlord space. at 75% loan to value on a £148,000 valuation. The mortgage advance was £111,000. That is an interest-only repayment of £430 per month. Now let us run the full capital recovery calculation, because this is the moment the strategy either delivers or it does not. We deployed the following cash into this deal: £29,400 as the equity portion of the bridging loan, £5,930 in acquisition costs, £22,000 in refurbishment costs, and £2,330 in bridging interest across 4 months of works. Total cash deployed, £59,660. The refinance released £111,000 from the lender. After clearing the bridging loan of £68,600, we received net refinance proceeds of £42,400. That means our net cash remaining in the deal is £59,660 minus £42,400, which equals £17,260. Now, the property is tenanted at £950 per calendar month, a figure confirmed by 2 local letting agents before purchase and achieved within 19 days of completion. Annual gross rent, £11,400. Mortgage cost annually, £5,160, allowing £1,800 for management fees at a standard 15%, £600 for landlord insurance, and a conservative £800 maintenance provision. Total annual costs sit at £8,360. Net annual cash flow, £3,040. That is a cash-on-cash return of 17.6% on the £17,260 still in the deal. And here is the crucial point. With that same £17,260 still generating returns, we are simultaneously free to deploy the recycled £42,400 into the next acquisition. That is capital recycling working exactly as the model intends. Refinance. Repeat. The cycle continues. Let us bring this together with 3 clear takeaways from everything we have covered today. Takeaway 1. The BRRRR strategy is not dead. It has evolved. The low-rate era allowed for sloppy deal analysis. In 2026, the model rewards precision. Your purchase price, refurbishment scope, and post-works valuation must be stress-tested before you commit capital, not after. Takeaway 2. The post-works valuation is the hinge point of the entire strategy. Everything you do during refurbishment should be evaluated through a single lens. Does this improvement meaningfully increase the surveyor's valuation? Cosmetic upgrades that tenants appreciate may not move the needle for a RICS surveyor. Focus your budget on structural compliance, kitchen and bathroom quality, and comparables. Takeaway 3. Know your money left in before you buy. The maximum allowable offer calculation is not complicated, but it must be done rigorously. Work backwards from your target refinance advance, subtract all costs, and only proceed when the numbers genuinely clear your minimum return threshold. Discipline at the front end of the deal determines everything that follows. If you want to run your own deals through this exact framework, download our free BRRRR Deal Analyzer spreadsheet. It is linked in the description below. It handles every calculation we covered today, including maximum allowable offer, cash-on-cash return, and refinance proceeds, all in one clean tool. If this video added value to your thinking, please subscribe to Property Investor TV. We publish new market intelligence every week and we do not pad it out. Drop a comment below and tell me, what is your single biggest barrier to executing a BRRRR deal right now? Is it sourcing, financing, or the refurbishment stage? I read every comment and I will address the most common answers in an upcoming video. And if you want to go deeper on bridging finance and deal structuring, our portfolio finance playlist is linked on screen now. I will see you in the next one.